Oracle's market story right now is a powerful blend of scale and momentum, a market cap near $922 billion and enterprise value above $1 trillion, paired with a roughly 52-week surge of about plus 134.71% that has put the stock in the spotlight for both bulls and skeptics. That momentum comes with an RSI around 83, which sits in overbought territory. So the setup is exciting, but also demands close attention to valuation and liquidity as the next chapter unfolds. On valuation, Oracle trades at a trailing PE of 76.03 and a forward PE of 46.48, with a PEG ratio of 2.33, signaling premium pricing relative to expected growth that will need to be validated by consistent execution. Enterprise multiples add to that picture. EV is sales at 17.42, EV EBITDA at 42.06, and EV EBIT at 55.36, levels that markets typically grant to companies with durable advantages and long-duration cash flows, but which can be vulnerable to any growth or margin disappointment. Profitability remains a core strength. Gross margin sits around 69.66%, operating margin near 31.46%, and profit margin about 21.08%, all signaling a software-like margin profile at scale. Over the last 12 months, revenue was about $59.02 billion, net income roughly $12.44 billion, and EPS about $4.32, a combination that confirms mature profitability even as the business invests for future growth. Cash generation is solid at the operating level, with about $21.53 billion in operating cash flow, but heavy capital expenditures of roughly negative $27.41 billion flipped LTM free cash flow to around minus $5.88 billion, which is an important nuance for investors who anchor on free cash flow yield. That dynamic also shows up in valuation through a P/OCF near 43.36, reminding that even cash flow-based screens are reading expensive at current levels. The balance sheet introduces both capacity and caution. Cash is about $11.01 billion against total debt near $105.41 billion, implying net cash of roughly negative $94.40 billion and about negative 33.61 per share. Liquidity looks tight with a current ratio of 0.62 and a quick ratio of 0.50, while leverage measures debt/equity at 4.27 and debt-to-EBITDA at 4.03 sit on the higher side, with interest coverage around 5.07, suggesting serviceable but not lax conditions. Working capital is negative at approximately minus $15.24 billion, which can be manageable in strong operating environments, but raises the stakes during macro slowdowns or if execution slips. This makes the consistency of margins and the trajectory of cash conversion particularly important as the company navigates its capex cycle and debt servicing needs. Ownership dynamics are distinctive. Insiders own roughly 41.46%, institutions about 45.12%, with a public float near 1.64 billion shares that can keep supply relatively tight in strong tape conditions. Shares outstanding increased about 1.78% year over year, and the buyback yield reads around minus 1.78%, creating mild dilution pressure that EPS growth must overcome to preserve per-share compounding. The stock's roughly plus 134.71% performance over 52 weeks reflects strong momentum, with beta near 1.46 indicating higher than market volatility, and an RSI near 83 signaling an extended technical posture. Price action sits above the 50-day moving average around 241.86 and the 200-day near 184.40, a constructive trend structure that favors momentum, but also elevates the probability of consolidation or pullbacks after such a steep run. Dividend investors will note an annual dividend of about $2 per share for a yield near 0.61%, a payout ratio around 41.68%, and an 11-year dividend growth streak that supports a message of consistency. That said, shareholder yield is about negative 1.18% due to negative buyback contribution, which tempers total capital return even as the dividend continues. Short interest is light at roughly 22.36 million shares, only about 0.80% of shares outstanding, and 1.36% of float, with days to cover near 2.16, indicating limited bearish positioning. This typically lowers squeeze dynamics, but can also mean fewer natural hedges are in place if a negative catalyst emerges unexpectedly. Looking at expectations, the consensus rating is buy, with an average price target around $308.50, which is about 6.04% below the latest price, hinting that a lot of the growth runway, 5-year revenue and EPS growth forecasts, near 19.67% and 27.81%, may already be reflected in today's valuation. With the last earnings date on September 9, 2025 after market, near-term results and guidance will likely drive whether premium multiples hold or begin to normalize. Oracle blends exceptional profitability and scale with premium valuation, tighter liquidity metrics, higher leverage, and a negative LTM free cash flow print driven by elevated capex, making the setup attractive for momentum, but nuanced for valuation-sensitive strategies. A staggered, pullback-aware approach is often how market participants handle this combination, while watching margins, cash conversion, and capital allocation for confirmation that growth and returns are tracking the premium already embedded in the stock. This is not financial advice, and any decision should consider personal objectives, risk tolerance, and independent research before acting on these insights.